Hi everyone. Today we will discuss certain important aspects of the Union Budget of India. The Union Budget of India, referred to as the Annual Financial Statement in Article 112 of the Constitution of India, is an annual statement showing item-wise estimates of receipts and expenditure during a fiscal year. Fiscal year, popularly known as financial year, is taken from 1st April to 31st March. Government prepares the budget for fulfilling certain objectives. These objectives are the direct outcome of government's economic, social and political policies. The objectives of budget includes reallocation of resources, reducing inequalities in income and wealth, economic stability, growth of the economy, employment opportunities, management of public enterprises, reducing regional disparities. There are two main components of budget: revenue budget and capital budget. Revenue budget includes revenue receipt and revenue expenditure. Capital budget includes capital receipts and capital expenditure. Revenue receipts include tax revenue and non-tax revenue. Tax revenue includes direct tax and indirect tax. Under direct tax comes income tax, corporate tax, etc. Whereas under indirect taxes comes goods and service tax, basic custom duty. Capital receipts includes borrowings raised by government to meet its excess expenditures, which includes borrowings funds from open market and other mechanisms like sale of 5G spectrum, etc. Capital receipts also includes recovery of loans given to various state government and union territories and other receipts like disinvestment. Capital expenditure is done by the government on infrastructure like flyover, metro, airports, roads, bridges, etc. Revenue expenses are done for the normal functioning of the government, which includes salaries for the government employees, pension, interest, subsidies, health facilities, defense services, etc. The Union Budget of India, which will be presented on 1st February 2023, will be known as Union Budget 2023 for the financial year 2023-2024. The budget estimates, which is the next fiscal year, will be 2023-2024. The revised estimates, which is the current fiscal year, will be 2022-23. And actuals will be for 2021-22. Union Budget of India has 14 documents, including the annual financial statements, commonly known as budget. Annual financial statement tells about the funds of government, which is the requirement of the Constitution. It includes Consolidated Fund of India, Public Account of India, and Contingency Fund of India. Consolidated Fund of India includes revenue receipts, revenue disbursements, capital receipts, and capital disbursement. The revenue receipts includes tax and non-tax revenues, whereas the revenue expenses are in the nature of industry and minerals, Indian Railways, transport, etc. Whereas under Consolidated Fund of India, in capital receipts, it includes internal debt of central government from securities against small savings, market loans, treasury bills, and external debt. Whereas the capital account disbursements includes medical and public health, food storage and warehousing, petroleum, Indian Railways, etc. Public accounts of India. Article 266 of the Constitution defines the public account as being those funds that are received on behalf of the Government of India. It includes small saving collections, income of government set apart for expenditure on specific objects like road development, primary education, reserve funds, etc., are kept in the public account. It does not belong to the government and have to be finally paid back to the persons and the authority that deposited them. A contingency fund is a sum of money set up for use in the event of national or state emergencies, such as riots or natural disasters, such as floods, cyclones, and other natural disasters. The Government of India has proposed to enhance the contingency fund from 500 crores to rupees 30,000 crores through Finance Bill in the Budget 2021-22. Government deficit. When the government spends more than it collects, then it incurs a budget deficit. Budget deficit includes revenue deficit, fiscal deficit, and primary deficit. Revenue deficit. It refers to excess of revenue expenditure over revenue receipts during the given fiscal year. It indicates the inability of the government to meet its regular and recurring expenditure, which it has proposed in the budget. It also implies that the government is dissaving because the government is using the savings of various other sectors of the economy for the purpose of financing its consumption expenditure. This implies that the government has to make up this revenue deficit from capital receipts, which is through borrowings or disinvestments. Fiscal deficit. It refers to the excess of total expenditure over total receipts, which does not includes the borrowings of the government during the fiscal year. What are the implications of the fiscal deficit? Fiscal deficit is an indicator of the requirement of the borrowings of Government of India for the fiscal year. Borrowings not only require payment of principal amount but also the payment of interest. Interest payments increase the revenue expenditure, which leads to revenue deficit, which will create a vicious circle of revenue deficit and fiscal deficit, wherein the government will have to take more loans to repay the earlier loans, due to which the country can lead to a debt trap. Primary deficit is fiscal deficit minus interest payment. It indicates the total borrowing requirements of the government excluding interest. It also means how much of the government borrowings are going to meet expenses other than the interest payments. Some interesting facts about the budget. Till the year 2000, the budget was presented at 5 p.m. From 2001 onwards, the budget was presented at 11 a.m. The first paperless budget was presented on 1st February 2021. Till the year 1955, budget was made only in English. By the way, the GST rates are not decided by the budget but are decided by the GST Council. Hence, they are not presented with the Union Budget of India. We will continue to make videos on such relevant and interesting topics. Do like, share and subscribe to our channel. Thanks for watching.